Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. And what I put together is kind of how I look and view, I guess, the investment climate out there right now, and kind of what my approach and thesis is of the channel. I go over this about once every week or 2 weeks or 3 weeks, somewhere in that range. I get a lot of new subscribers, and I usually refer back to a thesis or a channel's thesis, and I just go over it to make sure that everybody's refreshed on it. I put new data in it, and you can see how this plays out over time. I've opened the channel in August of 2020. It was right when I knew a commodity bull market was coming. I was talking to people about it, and somebody suggested that I open up the channel because I kept saying that people on YouTube didn't know what they were talking about, and that I would lay out this thesis for some people, and they said you should just open up a channel and go for it. So I did that. I opened up the channel, and I'm going to basically describe how I see the market and pace you through how I step through investments. So the first thing you have to do is you have to look at all of the undervalued assets in the world if you want to make investments. That's the easiest way to make money, to make copious amounts of money. I'm talking like big time money, not little 100% gains. I'm talking like tens of thousands of percent gains from bottom to top. You have to basically know when to invest in the cheap assets. And I use ratios to find out where those values are at. It's just pricing asset A versus asset B, C, D, E, or D versus E. I look at all of these assets priced against each other, against history. Then I choose what I would consider to be some of the cheapest assets that the world has to offer. Now, you can be in cheap assets, but there's got to be some trigger or something to reverse the trend of them getting cheaper and cheaper and cheaper against that other asset. So I dove in and did a lot of research to see what is a trigger point to change assets. What changes money flows in the system. And we'll go over that in this clip of what actually, in my opinion, changes asset money flows. And you can have excellent fundamentals. You can have excellent cash flows. That matters less than what you think. What matters more is the market conditions, because it determines where money flows. And you have to be in an asset where money is flowing into it, not away from it. And during certain market conditions, you can have increasing revenue, unless it's incredibly increasing, like some tech company or something. But you have to have increasing revenue that's going to beat what the market conditions are going to throw at you. So I'll just give you a couple of examples of what I'm talking about. When interest rates go up, it's a risk-free return is what they call it on a 10-year bond. When interest rates go up, people sell stocks and the PE ratios contract in stocks. People are less willing to take risk on stocks than they would be to just buy the bond at a higher interest rate. In an increasing interest rate environment, bonds also go down in value, existing bonds. So you go into a bear market in bonds. So what happens is people want to sell their existing bonds and go into something else. They want to sell their stocks and go into something else. And you can be making money in a stock in terms of the business making money, but the problem is they're going to get caught in an increasing interest rate environment, which is market conditions. That's my opinion, which is going to reprice assets differently. So that is important to understand the market conditions. And I've got market conditions in this presentation. And then also, if you're going to invest, if you're swinging for the fences, if you're going to be investing in high volatility stocks, you got to get your time frame right. You got to know how long you want to hold these things. I'm going to touch on that as well. You want to set up your portfolio so you're not taking too much risk in any one position. So you want to limit your position sizes to 5% of your portfolio or less if you're swinging for the fences in some of these really small cap stocks that are incredibly volatile. Some of them can have problems. Some of them may never materialize in a huge run-up that you thought they would. Most do, but some not. So that's also something to think of. So let's dive in here, and I'll show you some of the charts and what I'm talking about. So what I have here is a ratio in the upper left. It's the commodity to stock ratio. And when we want to be invested in commodities, you want a low ratio. And what we have today is an incredibly low ratio. It is off the chart almost. It is off the chart to the downside, which means commodities have never been priced this cheap in relationship to stocks. And you want to buy them in these circles here. You want to buy it in 1970, 99, and right now, today, and a year ago. And then you want to sell them when the ratio gets expensive, over 7 and greater. That's your sell point. And what I did is I looked at this ratio and compared it to real estate. And I noticed something over time. And just looking at the real-time CRB to S&P 500, this is commodity to stocks ratio, you can see that we bottomed the 50 days crossing the 200-day, and we are breaking out of a pattern to the upside. This is very bullish for commodities to outperform the S&P 500. So that looks fantastic. It looks like it's putting in a bottoming pattern. We are moving higher. We broke out of a large pattern here to give us a nice shot higher. So we have the valuations of commodity to S&P 500, commodity to stock ratio, means that commodities are starting to outperform stocks. That the thesis of the channel is correct. And when we were buying back in 2020 down here, getting our shares in oil and uranium and all these things, it is playing out exactly how we thought it was going to play out. The ratio and the valuation of commodities is going up against stocks. And that's what we were hoping to happen. Now, what causes this ratio to go up? What I propose and what I've researched through history is that the new privately owned housing unit starts, and all this is new homes being built, residential homes, single-family homes. And what I did is I overlaid the buy points and sell points on this chart. And that's what these points are here, these bottoms and tops. And what it does is it aligns with an expansionary phase of real estate. Whenever we go into an expansionary phase, this is the average homes being built per year. That's kind of the average that we want. Whenever we go above this average, we are in an expansion phase. And that's what this expansion phase here, expansion phase here, expansion phase there, expansion phase here, and so forth. Whenever we have an alignment where we have commodities cheap and an expansion phase of real estate, that seems to be the trick for a commodity boom, a commodity supercycle. And right now, we are aligning for a very large commodity supercycle. And why do I say large? When we look at this chart, you can see that we've underbuilt. This is what this yellow area is above the curve and under the average. Means that we underbuilt homes. We didn't build enough homes over the past because we had a problem with this overbuild scenario and foreclosures, which screwed up the housing market. The housing market is underbuilt a little bit over 5 million homes, which means that we have to build 5 million homes over the next decade, which means this could be a very big commodity bull market because inflation should be pretty large from this expansionary phase of real estate since we are so out of whack in the real estate market. And the millennials are coming up in home buying years, increasing the pressure on this deficit of homes, which is going to send prices higher. We also have the opportunity that we've never been this cheap in the commodity to stock ratio, which means commodities have never been this cheap in relationship to stocks. So we have the valuations off the chart to the low side, and we have a home deficit that is also incredibly out of balance, which means we could have a very large real estate expansion phase. Now, inflation comes from this. That's what I propose. New loans against new homes in real estate. That is expansionary in the credit supply. It increases the money units in circulation. Now, what this is going to do is it's going to put pressure on interest rates to go up. And what I have here is the 10-year interest rate, the Treasury bond. And last bull market, which is this green, the green to red arrow in the 70s and an increasing interest rate environment all the way till 1980, you can see the expansion phase, two of them back to back. What happened was it was the baby boomers coming into home buying years, and it increased the interest rates during that time frame because inflation from the housing market caused interest rates to go higher. But between the baby boomers and the millennials, the Generation X wasn't as large of a population. So we had a decline in interest rates between that period. And there might be other things also tied in, but the main driver is demographics. And that brought it down interest rates over time. And right now we are trying to break out of this downward channel very soon here. That's what the green circle is right here. And if we break this downward trend line and we go up an increasing interest rate environment, I think that it's going to put pressure on bonds and stocks to sell off and cause a rotation of money and assets into precious metals and commodities, because that is where the returns will be in that type of market condition environment. You can see US interest rates of 171 years here, 1871 to 2015, and you can see the cycle that I'm referring to over the period where you have a downtrend break, we go into an uptrend for a good long period. We break the uptrend to the downside, then we go to a downside period for a good long period. We had a massive move from the 1940s all the way to 1980 of a very large increasing interest rate environment, and then we've been in a 40-plus year decline in interest rates. What I'm proposing is that we could also see interest rates go into a new uptrend where interest rates increase over time, the long-term interest rates, and go into one of these bull markets of an up phase. That is profound because it's going to rotate a lot of money, more money than what most people think, out of bonds and stocks and into commodities and precious metals, possibly. I'm not saying 100%, but possibly if these rates break out. And we're looking at that right now. I am inclined to say that they will break out because I've never seen a real estate expansion phase have declining interest rates. So I am inclined to think that we're going to have interest rates go up. And I'm also inclined to think that COVID gave them an excuse to print a lot of money and hold rates down. That's my opinion. Now, looking at the this isn't gold price. This is oil price. This is not gold. This is oil. Looking at the oil price, we were in this upward trend line channel. This slightly upward skewed channel. And we've got this downtrend line that we just broke recently. I think we're going to move on higher over time, not in seconds or minutes, guys, in years. That this is going to move a lot higher and then put pressure in the system on inflation because it's going to get priced into everything. Oil is the number one commodity. So I suspect that this is going to go and increase quite dramatically and could even potentially be $300 or $400 a barrel at the end of this inflationary cycle. Now, looking at the gold to oil ratio, it looks like we're trying to break out of this bottom channel, this upward sloping channel that we have to the downside, which means that the ratio is contracting against gold. It is outperforming gold. Oil is. And what happens is you'll see this ratio in the beginning of a bull market break, commodities bull market, break the bottom of this channel and move all the way down and compress against gold over time. Gold will compress more towards the middle and end of the bull market after we get a crash in real estate. But oil here looks like it's trying to break the bottom channel here, the bottom trend of that channel, the trend line. And if it breaks, I think that we're going into a commodity bull market. And there's no reason to think not that it won't break. But let's continue to look at some data. We've got the CRB index. This is just the CRB index. Looking at it from 18, 19, 20, 21, we have this yellow period here, which was the COVID sell-off. So we were going to break in late 2019, the upside here. We had an upside breakout of commodities to go higher. And COVID brought this thing down. In fact, in 2019, late 2019, someone in a large group of banks and everyone knew, even though we broke to the upside, that something was coming and that there was going to be a market sell-off, because that's why the CRB index sold off so rapidly before COVID even had the announced shutdown. Means the banks and the big investment firms knew that this was going to come before it happened. That's why we see the sell-off like this. Then we sold off all the way to the bottom. This was the buying opportunity of a lifetime, all in here, anywhere in this range, coming on up. And we're continuing to move on higher, even in the near term. The copper to gold ratio also signaled that we had problems in 2019. People were favoring gold over copper, so they were selling copper at a faster rate here, and we had a massive move before the COVID sell-off. So they knew, people in the markets knew that something was coming before it came, and that's why this sold off so bad. We broke this downtrend line, and we've been moving on up, and we're creating a pattern in the copper to gold ratio where I think we'll break to the upside for copper to outperform gold. Copper has a market balance that's messed up. It is running a deficit, which means that more copper is needed in the markets than what is being supplied. And it's going to put upward pressure on copper for the next 10 plus years, because we don't have the projects in the pipeline to bring on for the supply needed for that demand. So I'm a big copper bull. Now, also looking at this is the gold to monetary base ratio. When we were under a gold standard, it was around 3.5. We started cheating and printing a lot more money than gold, and we drove the ratio all the way down here in the 50s and 60s. When gold was freely traded in 1971, gold accounted for all the money that was in the system, and it accounted for it in that expansion phase of real estate. The expansion phase was this here, then we had a little sell-off in real estate, and then it expanded again. What I'm proposing here, and we had Gen X in between, this huge disinflationary, deflationary area, however you want to say it, we are coming up to the millennials being a bigger demographic, and a huge expansion phase of real estate is coming, which I think, breaking out of this descending wedge pattern, that we could reaccount. Gold is going to account for the monetary base and potentially go all the way up here over time. And it could be a drastic move. So I'm positioned in precious metals. And remember, I'm talking a lot about gold to oil ratios. There's two components in what price a commodity. It's the inflation aspect, which is gold, because gold is going to account for the monetary base. And then there's the compression of the ratio of, let's say, oil to gold, where that ratio compresses. The compression against gold is the supply-demand dynamics. So the supply-demand dynamics are going to get priced in because almost all these commodities have very good supply deficits coming up. And we also have the inflation component that's going to push these higher as well. It's a twofold increase. And Where we are today is an incredibly low area for where gold has not accounted for the monetary base, and they are increasing the monetary base rapidly, which means that gold could revalue much, much, much higher than where we are today. Now, looking at the CRB to S&P 500, just to give you a little bit bigger picture view on this, we broke a long-term downtrend just recently in 2021, and we're breaking another pattern that I showed you up top again. I just wanted to give you a little bit bigger picture, and I forgot to put it up top. So we have commodities outperforming S&P 500. We've broken the big picture long-term downtrend, and we're also breaking patterns on the short term. This is a huge positive development for our investments. It is saying that we are right. It is saying that commodities are outperforming stocks and that we are in the right investments at the right time. Now, notice how long this declined. It went from 2008 all the way down to 2021. I suspect that the upside could potentially be very similar to that downward movement. So we could be going up for a very long time, this ratio. It's going to take some time for all this stuff to rotate. And maybe it doesn't take all that time. Maybe it does it in a much quicker pace. I don't know the future, but it's broken the big long-term trend. We break in short-term patterns, and every single chart I'm looking at is breaking these long-term patterns. The CRB to S&P 500, the gold to monetary base is breaking it. The CRB index overall in general is breaking it on a basis there. The copper to gold ratio, which means that we are breaking it for a commodity boom. The oil to gold ratio is breaking in a favorable direction. Oil is breaking to the upside. Interest rates are trying to break to the upside of their long-term pattern. We are in an expansionary phase of real estate, and the valuations are incredibly cheap for commodities. So every single thing I've showed you so far has been in support of a commodity market boom. There's not one single piece of data that I can find that is saying that this isn't going to come. These are all structural moves in demographics of people. You can't stop this with financial means. You can only make it worse. Now, I'm going to jump in here real quick. When the Federal Reserve went into power, they are amplifying the moves of these ratios, and they're amplifying the moves of the assets. So we're seeing larger overvaluations and larger undervaluations in these moves. If we can buy these commodities at the lows that we've got, and we can hold on through this entire valuation up, which may take 5 to 10 years plus, we are going to see the largest potential moves that anyone has seen in anyone's lifetime, because the extremes of the lows and highs are so massive, which means that we could be buying assets cheaper than anyone else has ever seen. And eventually, because of inflationary measures, because of interest rates changing on them, all of these things are going to reprice all these assets very differently. And the money that's going to be flowing money's been flowing into stocks and bonds continuously. And it created this massive imbalance of overvaluation in those assets, bonds and stocks. Now, the bonds and stock market is way larger than commodities and precious metals. So when this rotates back, it's going to be a massive amount of money, which is far larger than where it's flowing into in the commodity and gold market, which means that the upside could be way higher than what we even think because of all the money flows. Now, I'm going to show you a couple of individual companies, ones that I have invested in, and some more ratios. This is the pound of uranium in gold grams. This is a ratio. So it's the uranium to gold ratio, but it's in gold grams. When this ratio goes up, it means that uranium is outperforming gold. And what I'm seeing here on the right-hand tail side is that we have a contraction or descending wedge where we're coming on down, and we just broke, I've got the green little circle there, we just broke out of this pattern to the upside. What this is suggesting is that it's more than likely at some point, and I can't tell you the exact timing, uranium's going to outperform gold, and it's probably going to do it massively. We have very large supply-demand imbalances in uranium right now. It's a large deficit. So what I suspect is that this ratio is going to move vastly higher, very similar to the mid-2000s, late 2000s. And I think we're going to move and drastically go way, way higher. Now, if that's the case, we should see signals in uranium and oil companies that are showing bottoms in their patterns. And what I have up here is SM Energy. This is a very volatile company. It's a small, we'll call it a small to mid-cap energy company. They do oil and natural gas in the United States. I have a buy signal. The last buy signal was this green circle, and the last sell signal for the valuations is the red. That's the stock to commodity ratio. Buy, sell, and this would have been your entire move that you would have gotten. We went into a descending wedge. This is a consolidation pattern at 2015 or so. We sold off, went into a descending wedge. The green circle is where I went like very heavy into SM Energy in this little corner here, and we've been moving on up. I suspect this to move way up. I think we're going to blow past its old-time highs at some point. I can't tell you exactly when, and I think the move is going to be gigantic. It's going to be a pretty fun move. We could have, we could in between have to ride through some volatility. We could also go nowhere for 6 months or even a year long. We can see that we went nowhere from 2001 to 2004. It's kind of a long move that we didn't do anything, and then all of a sudden it took off again. I am playing this for the valuations because oil was at an oil to gold ratio of something that we've never seen before. It's never been this cheap in history. And same with this area in here. It's around 50 to 1, 50 barrels of oil to 1 ounce gold. That's when I was like, I got to load up. It's super cheap and the ratio is compressing. So I was loading into SM Energy and buying it, and we're seeing the bottoming pattern. The bigger the pattern, the bigger the move. This is a massive pattern. Goes all the way back. This is the big move up, the big move down. And you buy it at the bottom, then you hold on. We're seeing it in uranium companies. This chart here is matching Bannerman Energy. And you could see that this is a long-term accumulation bottom, and we're just breaking out of it. We are moving to the upside. The green circle is roughly the green circle of where I started the channel and where I started buying. That's where I loaded up. And looking at Encore Energy, another uranium company in America. This one's in Africa, Bannerman. You can see, obviously, this is where I started the channel and took my stake in Encore. We came down, and now we're moving back up. And I think we're going to continue higher. And by looking at the valuation of uranium, we're barely getting, we're just getting moving. This is in August of 2021. It's a little bit delayed, but we're just getting moving. This is going to rocket higher. And now is the time to, allocate some money, in my opinion, to uranium and oil. I've got Northern Oil and Gas. This is one that I've been purchasing more recently. Why am I purchasing it more recently? It is a laggard. So when I make money, I have money to invest. We broke the downtrend here in 2018. It came up, pulled back. COVID gave us the buy of a lifetime down here. We broke this downtrend line, and we're coming back up. And there's a lot of runway ahead of us in terms of valuation of the oil to gold ratio and in terms of Northern Oils and Gases chart. And I put this one in here. This is the platinum to gold ratio. When platinum outperforms gold, it means something. It's like the copper to gold ratio. It means that we're entering a commodity bull market and an inflationary period. What we did is we broke this trend line coming down through here. We broke it to the upside, came back and back tested. I like buying on the back test. I buy physical platinum. And I think we're going to see platinum head on higher here and outperform gold. So platinum is my choice of physical metal. I also think silver is going to do incredibly well. It's just a little bit more in the future. When platinum outperforms gold, it means that we are in an inflationary cycle. It means that stocks are most likely going to underperform commodities and gold. We've seen that in history. There's been some people who've done some studies on this, and it matches with what I see in history. So I wanted to touch on all of these things. I touched on some companies, and you can look at any of these companies. You can chart them all out. They all look fantastic in the commodity sector. You could go Mosaic in a fertilizer company, or ADM, which is Archer Daniels Midland. You could do Caterpillar, Komatsu. It doesn't matter what it is. They're all putting in bottoming patterns. It's aligning and having confluence of all of these pieces of information saying that we're going into a commodity bull market. All of these charts that I've shown you right here are evidence that we're going into a commodity bull market. And what dumbfounds me with some of these investors is I don't know what they're looking at in terms of how they think an S&P 500 or a NASDAQ composite is going to outperform this. These are completely underpriced. The value here is immense. It is still incredibly undervalued. And I am continuing to pile money into this stuff. I'm cost averaging in because I still think it's of insanely good value. This bull market is just getting started. Now, I want to talk about another thing, and I know this is getting a little bit longer. When you invest, you have to get your time frame nailed down. Your time frame should be 10 years plus here. Your time frame has to be that long. And when people worry about short-term movements, they do stupid things. I was there. I did it. I'm looking at the valuations that are never been this cheap. We're talking over 100-year lows. Never been here. We can buy assets, the cheapest, knowing this, we can buy the cheapest assets in the world and hold on and get 10, 20, 30, 40 times our money or more. Why wouldn't you hold on? Why is everyone so concerned about the short term? Now, cost average in if you're concerned. Buy it in increments over time. I got caught in the COVID sell-off. I did not sell anything. I bought more. That is how I mitigated, not really mitigated risk. That's how I took advantage of that opportunity. I am so involved and understand the ratios so well that I knew this was going to come back. I knew that I had to buy these assets at this price. And I mainly bought a lot of platinum. I bought silver, physical, and I bought a lot of companies. And what I'm doing now is I'm continuing to purchase because I think the value is still there. I think this is just getting started. We are just breaking to the upside. All of the opportunities are here, and I think we're going to see this stuff materialize, the upward movements, right in front of our eyes. We have large inflation coming in front of us. That's why we're seeing the oil price move up so much. And you're going to see people, they're going to tell you things. And I don't care what Cathie Wood or what some of these investment fund managers say. It doesn't matter to me because the chart that I'm showing you, all these charts, are evidence that this is going to happen no matter what. It is demographic driven. It is structural in nature, which means that the markets are going to have to provide more oil, more copper, more uranium, more, and go on and on and on. And commodities are the spot to be, in my opinion, because that's going to be the benefactor of inflation. The people who use commodities in their products are going to get hurt a little bit more than the commodity producers. So the money is going to flow into the pockets of the commodity producers. And I don't think that the companies that have commodities as inputs are going to make as much money. I think their margins are going to remain flat, and they're going to have to continue to increase prices to have flat margins. So I think the spot to be is commodities. Now, we are running into shortages of some of these commodities. There are going to be some large deficits. And with oil going up as high as I think it's going to go, there are certain investments that do better than others. I think physical precious metals are going to do insanely well, and you could probably buy most likely any of them. But I like platinum and silver, and gold's a good one from a monetary aspect. We saw that the gold to monetary base ratio there. I think they're all going to do incredibly well. They are inflation protected. So it's an asset that's going to do very well during inflation, although a mining company with the input costs of oil may not do as well. You also have risks with mining companies where they could get nationalized, they could have increasing taxes, etc., against them. You can also have that risk with oil companies as well, because everyone hates oil companies for some reason. When they make more money in a commodity boom, they're going to bring them into, the government is going to bring them in, and they're going to ask them, why don't you produce more oil? They're going to bring in these big ExxonMobil, which produces like 1 or 2% of the world's oil, and it's mainly OPEC. Now, they're gonna try to tax them more and do all these stupid things to them. But another thing to also think about that I'll talk about is OPEC. OPEC, everyone thinks they have all this large spare capacity. All I'm going to say is the decline rate of 1 year is going to eat up their entire spare capacity, which is like 6 million barrels of oil. All it takes is a little bit of underinvestment in a couple of years and demand to come back, and we are in a massive problem. And it looks like that is setting up that way, which means that we have massive inflation, we have massive problems in supply demand, and we're going through what I think is the beginning of an energy crisis. An energy crisis is going to blow these companies up. They're going to, to the upside. They're going to go way higher because oil, natural gas, and energy is going to go way up. The input costs for renewables are going to skyrocket. There are going to be shortages, I think, of minerals. Copper is one in particular, potentially silver, and potentially some other metals that are inputs to building these renewables. If we can't scale those and the cost of those renewables go up exponentially, do you think people are going to want to pay more money for energy? Or do you think they're going to have to go after something that is cheaper? I don't know how this is necessarily going to play out. All I know is that natural gas, uranium, all these energy companies are going to do incredibly well, in my opinion, because of the valuations, because of what is happening to oil and natural gas, and what could potentially be an energy crisis. And if you're in those investments, we could see some massive, massive appreciation moves in these sectors. Physical metals will go up with it because if you have an energy crisis, you can't get the metals out of the ground. There is a barrier between you and the metals. It's called earth. And in order to move earth, you need copious amounts of energy. And very energy intensive processes are going to yield, they're going to need much higher prices. So if you own the physical metals in your hands, well, they're going to go way up. And you have the least amount of risk of anything in terms of taxes, in terms of everything. It's the least amount of risk. So I own a very large percentage of my net worth, 25% or so in physical precious metals. Royalty companies don't have that input cost dynamic. So I'm in royalty companies as well. I'm hoping that they can do very well. I know you pay a premium for it. There's a reason you pay a premium for it, because what's going to happen to mining companies is their margins probably won't grow. You're going to need far higher prices. So royalty companies make money off of volume and price for the most part. And I think they're going to make a lot of money. So I overweighted the royalty companies. Now, some of these big diversified mining companies I think are good as well. And they are pulling back right now. They're down. VALE, Rio, BHP, Norilsk Nickel, NILSY, South 32, some of these larger, Glencore is a larger copper company. These larger companies, they are diversified. They mine a lot of different things. It's basically a play on the commodities itself. They also pay very large dividends. if the world needs all of these minerals, I think they're good plays because they're going to pay you a huge dividend, and they're going to be a huge commodity play. So if any one commodity goes way up, they're going to capture it. They also have some uranium assets and energy assets. So I think that's like the holistic way to play it with pretty good risk reward returns. So it's lower risk, pretty good rewards. So that's kind of how I'm playing it. So energy sector, very heavily in the energy sectors, the diversified miners, royalty companies, and physical metals. I also do have some mining companies. They're not, it's not as big, and it's spread out. But I'm going after some of those smaller mining companies, and if some of them, hit it big, I'll be in it. So I think that's about all I have for today. If you guys have any questions, put it in the comment section below. Hopefully this gives you a really good picture of the commodity sector in general and the thesis of the channel. If you guys like this content, give me a thumbs up, and thank you for listening. This is Finding Value.